the banking sector stresses force the banking sector to slow the economy down by slowing down lending and what have you, then they're doing Fed's job. So the Fed may not need to raise rates. So if I were to say today, I think it's a 50% chance they go 25 basis points, 50% chance they do nothing, and almost zero chance that they go 50 basis points. So that's off the table. And it's kind of a toss-up, depending on what happens over the next 2-3 days. Does the turmoil continue? Does it start to settle down? I think it'll be a close call because inflation, I think the expectation is that slowdown will help contain inflation.
So it would be logical to think that the US will pause, which is what Goldman and all are saying, that they will not hike this time. They can still use harsh language. They can still say that we are just pausing it for now to give you time in some sense. It would be a bit funny that on one end you are saving a bank and on the other end you are raising rates in that 15-day, 10-day period. Now, it does not mean that alone will make the market celebrate, because the market may say that means they know something we don't know. They are worried about the economy, blah, blah, blah. So, beyond a point, it's always difficult to say what stand the world or the markets will take on, even if there is a pause. And in the beginning, it'll have to be a temporary pause as conveyed by the Federal Reserve. In the end, it may be permanent also.
And you very likely will have perhaps 25 basis point rate hike in the next Fed meeting. It sort of tells you that the reflects that asset market. So it's a good news for bonds, though, that bonds are getting solved, that more rate hikes are not going to come. Fed is going to be less hawkish. And of course, all said and done, the financial conditions have tightened quite dramatically. And to that extent, it is kind of 25, 50 basis point excess rate hike already in the system, flushed in because of the bank run and such likes. Everyone is sort of now on a back foot. But that does not yet mean, as we said and argued, that, it would be that, there'll be Fed unwind or ECB unwind happening anytime quickly.
Market has substantially repriced the amount of hikes that they were expecting. I think just about a week ago or 10 days ago, we were looking at a terminal rate of about 5.5%. Today, I think the market is somewhere between 4.75 to 5% camp. The theory is that whatever is happening in US with regard to community banks will lead to significant tightening of credit standards and credit provisioning, which will in turn have an impact on the cumulative demand and the economic output, as well as on the on the inflation. So that's the channel through which the market is thinking that will have an impact on the US economy. And that's why probably the amount of tightening that Fed had initially was required to do is no longer required to do. This is something which is a very shifting sand. I think things are changing on a daily basis. So we'll have to see where the market ultimately settles, but it's quite possible that we may now not need to see as much of a hike as was initially thought, particularly after the last testimony of Chairman Powell.
It will be very difficult for the Fed to retract from the series of policy rates, because if they don't do the rate hikes, then actually the markets will move ahead of the Fed, and the markets will then actually demand that the Fed doesn't do a rate hike either in the subsequent policy. But my sense is that the Fed could actually go with a 25 basis point rate hike and then take the situation as it demands, because the Fed has been consistently raising rates. It's justified. Inflation is not under control, but my sense is that a rate hike magnitude of lower is on the window.